Hey everybody, I'm Kevin,
I'm Debbie.
and we are gonna do a series on mortgages, home buying, and all the things under that umbrella. So I will let the expert introduce herself.
Hey everybody, I'm Debbie, and I've been in the mortgage business for over 20 years. I've helped hundreds of people to purchase their home, and I'm also a licensed real estate agent. I'm currently in Charlotte right now, but I'm licensed in New Jersey.
We are gonna start with the top 10 questions that you guys, as people, Google about mortgages. So the first question is, what is a mortgage?
A mortgage is a debt, and basically what that means is that the bank is going to lend you money based on your qualification. So when you're looking for a mortgage, so a mortgage, you can do a conventional, you can do a FHA, you can do a VA, you can do a USDA. Now you know that a VA, you have to be a veteran in order to qualify for a VA loan. But the other three loans, anyone can get those.
How much mortgage can I afford?
So I know the standard answer when you go to Google is going to say 28% of your income. But let's be real. In order to qualify for a mortgage and qualify for the largest debt that you're ever going to take on in your life, in my opinion, you need to be able to use one of your paycheck to pay that mortgage. And not just your mortgage, everything that comes with that mortgage.
The next question is, what credit score do I need to buy a house?
I know that when you go on Google, again, it's going to give you the standard answer, right? Based on a conventional loan, that score is going to be different. Based on a VA loan, you don't even need a credit score for VA and USDA. FHA, they're going to go as low as probably in the 500. But again, I feel like the higher your credit score is, the better interest rate you're going to get, and the less you're going to pay in interest payment.
So, should I wait until I get my credit score as high as possible, or should I still go ahead and do it if I'm in that mid 600 level?
I don't say wait because I know owning a home is the American dream. But not only that, when you own a home, it's better than paying rent. In my mind, I feel like and I'm also an investor myself, so not everybody's going to own a home.
Uh-huh.
But if you're in a position where you feel you're ready to do this and you're paying somebody else's mortgage every month, I say go ahead and do it. I will never deter someone from wanting to get their dream. I think having dreams and goals is a great thing, and I think owning a home is one of the best investment that you can ever make.
So, question number four is, how much do I need for a down payment for each of the loan types? The average person thinks that you need 20% down, and that usually deters people from buying a home, if we're being honest.
Well, to be honest, conventional, yeah. FHA, no, 3%, right? VA and USDA, you absolutely do not need a down payment, right? You don't even need a credit score for USDA, but understand USDA loan is a special type of loan that you have to be in a certain location because it's a rural housing development loan. So
Okay.
if you go on USDA site and you put in that address and it doesn't come up in in that location, you will not be qualified for a USDA loan, right? But there are programs out
Mm.
here that can also help you with your down payment. There's a lot of first time home buyer programs out here.
Question number five, what is PMI?
PMI is private mortgage insurance, right? It is to protect the lender. It is not to protect you. You make those payments, but in the event that your mortgage go into foreclosure, the bank is protected, not you. You're not going to get that money back. You're never going to see that money back. And 90% of the time, that money is goes toward the bank regardless. Doesn't matter if your loan never goes into
With
default.
the question number six, what are closing costs in a mortgage? Appraisal, title insurance, loan organization fees, and prepaid taxes and insurance.
So prepaid taxes or insurance or your escrows,
Okay.
right? Titles are title fees that the title company is going to charge you based on the fact that they have to insure your property. So title comes in when you buy a property, you have to have title. Title conveys ownership, right?
The title of the
The
house.
title from the house, and it
Okay.
has to be insured. It has to be free and clear. And if it's not free and clear, you cannot sell that property.
Okay, so if there's like a lien or something against the
Exactly.
property, that all shows up on the
So you
title.
pay title fees so the title company
Mm-hmm.
can run a report on you, the person, and the property to make sure that it is free and there is no encumbrance, meaning there is no debt on that property in order for you to sell that property.
Okay. And then the other two were appraisal and loan origination
So
fees.
appraisal, what appraisal is, it basically appraises your property. It's not a Zestimate, it's not a Zillow. It's
Okay.
actually a professional that comes in, and based on the location where you're located, they will do an appraisal within a certain mile radius. So if you have a 3-bedroom, they take it in comparison. You looking at another 3-bedroom with the same amount of square footage,
Mm-hmm.
the same amount of whatever upgrades that you have. You can't have a property that they for 30 years they haven't done anything, and then you're doing an appraisal on a property that's new built, right?
Gotcha.
It doesn't work that way. So you need a professional to come in and give you a professional opinion of why that property is worth what it's worth. And the lender will never give you a loan if that property doesn't appraise for either what it is or over that value.
Loan origination fee.
So loan origination fee, there are costs to fees to get these banks money, right?
Mm-hmm.
They don't just give the money away, right? If I'm gonna lend you money, there's gonna be some fees to get this loan, just like any other loan, right?
Okay.
Just like a car loan, there are fees that goes with it. There are people that work for the bank; they got to pay these people.
Gotcha. And it says these costs are usually 3 to 6% of the home's purchase price.
That is correct.
Okay.
Yes, and it could be a little bit more, especially if your credit score is not where it needs to be.
Gotcha.
We pay more when our credit score is below what the bank is looking for, because they're already saying that we're high risk. They know that you may come in default on this loan, but they're still willing to give it to you, but they're going to give it to you where they don't take a loss.
And question number 7 is, should I choose a 15-year or 30-year mortgage?
So here's the thing. Every individual, when it comes to a mortgage, is an individual.
Mm-hmm.
It is your financial situation. So if you say, should I, it all depends on that individual. Mm-hmm. I may be able to afford a 15-year mortgage because you know what? I may be able to pay another extra $1,000 on top of what my budget allows. Mm-hmm. You may not be able to because you're living on a certain budget. So if you know that $2,000 is all you can afford to pay, mm-hmm. then you may want to go for that 30-year.
Right.
If you're saying, you know what, in 15 years, I want to pay off my mortgage. And how many people live in that same home for 30 years? They don't.
Not a lot.
They really don't. So again, it's like, but here's the thing. If I'm going to live in it for 30 years, then I may want to do the 30 years. Mm-hmm. If I'm going to live in it for 15, I may want to take the 15 and say, you know what? But in my opinion, I would never buy a house cash. And I would never pay it off. Because to me, I feel like even if you pay off your loan and you still live in the property, mm-hmm. all that money is still sitting in the house. It's not working for you.
And that's the equity.
Yes. So financially, what does it benefit for you to pay off your property? Let me tell you what happens. A lot more people can sue you because now they see that somebody's trip and fall in your driveway. Mm-hmm. You're more liable and more susceptible to someone coming to sue you because they're coming after your house. Because there's no longer a debt. Yes. Whereas when you have a mortgage on it, the mortgage payment is so much that nobody thinks to sue you.
Okay. That makes sense.
So in my mind, I'd always want to keep a mortgage payment.
Okay.
Because I want my money to work for me.
Exactly. All right. Question number 8 is, what's the difference between pre-approval and pre-qualification?
So pre-qualification, let's take that. I think that should be thrown out the window. But that's my opinion. Right? Don't mean nothing. I feel like pre-qual, what happens is that I'm taking your word for it. You came in, you sat in front of me, and you told me you made $150,000 a year. Mm-hmm. I haven't seen any proof. You have $50,000 in the bank. No proof.
So that's like when you go online on Zillow and you just tell them, oh, I got 700, I'm good, I make 110, and then they say, oh, you pre-qualified for...
Means nothing.
Okay.
Just your word against what the proof of the pudding is.
And then pre-approval.
Pre-approval is when you show me your documents.
Okay.
And you're saying, okay, here is your document. Here is my pay stub. Here is my bank statement. Here is my credit card bill. Here are all the things that I see the proof now in the pudding that I'm like, all right, now I could put pen to paper and I could say, I can start doing my calculation and saying, okay, when I send all of this to underwriting, because somebody is underwriting this file, right? Underwriting is going to look at all these documents and they're going to say, okay, you qualify for this $500,000 loan.
Gotcha. So they check everything, your credit, your income, and all
If
that.
they do everything, they literally call your employer, make sure you're employed. They look at your bank statement. They want to make, and it can't be, a lot of times they want to print out from the bank. They don't even want your online statement. They want to make sure that whatever you say you have, your 401k, whatever it is that you're bringing to the table, if you're getting money from relative friends, they want to see where that money trail is coming from.
Question number 9 is, can I get a mortgage if I'm self-employed?
Yes, you can, but you have to show 2 years of self-employment tax return. The problem with being self-employed is that most people don't report all of their wages.
Because they don't want to pay
tax, and that's where the issue comes in. But now there are lenders that have come out and says they are willing to work with self-employed, because what they realize is there's so many more people that are self-employed now than ever before.
Right.
So you absolutely can get qualified, but you have to say to yourself, okay, now I'm going to have to report, because based on my income, which is going to be checked, and your bank statement of what money you are bringing in, which now opens you up to the IRS.
Right. So you may have to pay some back taxes or something,
or you may have to wait a year or two to get your
every ducks in a row.
Yes, to get yourself in a position to purchase a home.
Okay. And the last question is, when is it smart to refinance?
I know everyone says run when the interest rate has dropped. Okay. Again, I truly believe in mortgages. You have to look at your financials, because again, we could run to refinance, but why are you refinancing? Just because the rate has dropped? Because with that still come those fees that we just talked about. Right. And a lot of the times they'll push you and say, oh, you could put those on the back of your loan. But just think about it. Every time you add to your loan, it adds more years to your loan.
Right.
So you started out with a 30-year loan and you started out with a $300,000 loan. But let's say now you refinance and now the fees have added up and now you have another $10,000 and that's added to your the back of your loan.
Right.
Everything you add to your loan eventually comes due.
Right. And it'll stretch.
It's going to stretch, and the bank is not going to forgive it. They're not going to forget about it.
They're going
to make you pay it.
Gotcha.
Right.
We're going to end it here. That was episode 1. Stay tuned. Like, comment, subscribe. Drop any questions that you have in the comments, and I'll be sure to get my mom to answer them for you, or if I know it, I'll answer for you. And we'll be back with episode 2. Peace.